All right. Hi, everybody. I'm Stuti. I'm a partner at Triton Capital, formerly known as Kraken Ventures. And our investment thesis is that blockchain is better technology infrastructure for financial services. So all the panelists here, Kiln, and this topic today very much embodies our thesis. And we're also proud investors and backers of Kiln. So today I'm honored to moderate this panel, bringing together some of the world's leading experts on stablecoins, both from a DeFi perspective, institutional perspective, and fintech perspective. So we really have everything you need to understand this topic. So first panelist is Stani. He is founder of Aave Labs, and he's truly a DeFi pioneer, building one of the first and largest decentralized lending exchanges. Second, back there is John Egan, head of crypto at Stripe. And so, John, I believe you oversee Stripe's portfolio of crypto product and solutions, which are driving innovation when it comes to crypto payments and financial infrastructure. And finally, we have in the middle here, Nick Van Eck, CEO and co-founder of Agora, which is committed to the mission of providing a global liquid digital dollar. All right. So first, I want to start with looking back. Really, what is the evolution of stablecoins? So stablecoins have grown from being a niche tool for crypto natives to trade in DeFi to becoming a multi-billion-dollar industry, which is powering all institutions, and in many ways is also exporting global welfare to new kinds of markets. They have already started to make a real impact on the global financial system. And I'd love to hear, perhaps, Stani, you've been in this industry for a very long time. What were some of these key inflection points that have driven their development and adoption through now?
Yeah, I mean, when we started building Aave and even earlier days, Egan, stablecoins weren't really on Ethereum at all. Like they weren't like in a EVM compatible environment. So you had USDT, for example, which was mainly used on centralized exchanges, and it provided a convenient way of an exchange to allow users to hold a stable value and trade against other assets. And it was kind of interesting because when we were building these very early DeFi primitives, we really didn't have stable value. In fact, one of the first versions of our products, users were basically borrowing USD-pegged ETH and returning USD-pegged ETH, which means that you basically contractually agree on USD value that you're borrowing on chain, but you're still using Ethereum as a medium of exchange. And I think the exciting part came, I think it was like 2018, 19, when you had more decentralized stablecoins on Ethereum, and you started to actually see them being used on lending applications, and you had this concept of yield. And at that point, that was quite significant because we were still in a very low interest rate environment. So obviously today, yield is across all fintech and DeFi and so forth. But at that time, there was very little yield in TradFi. I hope me using words like TradFi doesn't offend anyone. It's really the way I talk. But what I'm trying to say is that at that point, when you came to DeFi and you were able to actually earn on your asset in a stable way, more higher than, for example, your savings accounts was providing, which is at that point 0. That was pretty interesting, kind of like a concept, because you could start building these different DeFi primitives and actually package products and access them in a non-custodial way. So that was the first thing. And now, a little bit obviously later, it's becoming more obvious of the fact that stablecoins are a great way of actually transacting value globally, but also preserve capital and participate in different kinds of yield opportunities that we see, for example, in the decentralized finance. And I think that's really exciting.
Mm-hmm. Yeah, and John and Nick, do you have additional perspective on the moments that you consider as key towards the adoption of stablecoins?
Yeah, I think Stani touched on sort of stablecoin era 1.0, which was, Tether, they were like the original visionaries that brought dollars on chain because, folks here remember, and I don't know, when folks got into crypto, BTC was the primary asset that other cryptos traded against, right? Obviously, that's not necessarily great if you want to just be sitting in dollars when you're moving in and out of different positions. And so that's how Tether came on the scene. Then you sort of had this stablecoin 2.0 era when Binance, Coinbase, a lot of these centralized exchanges launched their own branded digital dollars. And now I think we're entering an era, stablecoin 3.0, which is what I call it, where you're actually having stablecoin networks that are developing where they push value back to different businesses or user profiles, right? Because over the last 10 years, everyone outside of USDC and USDT has been pretty much cut out of the economic equation on the centralized side. And so that's why we actually started Agora, and it's a centralized institutional grade digital dollar. So the assets are at State Street and a cash custodied fund, fund administered fund. VanEck is the investment manager. It's all overnight reverse repo, short-dated U.S. Treasury bills, and cash. And what we do is work with businesses or applications or DAOs and say, hey, you're actually driving utility and liquidity for these assets. You deserve to participate in those economics, right? In addition to that, we're also having a number of different businesses, whether they're consumer wallets or fintechs, build on our infrastructure, because a lot of what we're doing is abstracting away complexity, right? Of the asset management, of regulation, interoperability between blockchains. And so I would say now is one of the biggest inflection points, because what's really gotten us from 0 to 200 billion today has been crypto trading on centralized exchanges and a little bit of DeFi and EM dollar demand. I think what gets us to 10 to 20 trillion over the next 20 years is really eating the Eurodollar market, but continued EM dollar demand, cross-border payments, FX, and then as institutional finance comes on chain, stablecoins are going to be that sort of interop asset between whether it's fixed income products or tokenized equities, et cetera.
Yeah, and John, I'd love to understand, from the perspective of a fintech, what brought Stripe closer and closer to kind of some of these big decisions that were made recently, such as the acquisition of Bridge and other products that you're building out.
Yeah, I mean, just to talk a little bit kind of the history, which sort of brings us up there, right? I might focus from our perspective a little bit more on the history of payments and sort of global money movement as it relates to the eventual evolution of stablecoins fitting that use case really well for a company like Stripe. We've been in this space in some way or another since about 2014 when we were trying to do it with Bitcoin. And if you think about sort of the four major advantages, right, of stablecoins around speed, costs, global default availability, and programmability, right? We really didn't have all four of those back then. We really sort of had maybe global by default, maybe a degree of programmability, certainly not speed, and certainly in the worst cases, not cost. And so in that world, I think we had an initial amount of demand in terms of how do we go and start activating this kind of new global by default payment rail. But we really just got headwinds of the consumer experience being sort of terrible. If anyone here ever went and tried to buy something in 2014, I know I certainly got a few hotel rooms through Expedia back when I think Stripe was supporting them. And I think that was about an $80,000 a night hotel room, if I sort of map it forward. Most people regret every Bitcoin that they ever spent. Not a great experience. So when we sort of map it forwards, it was a really natural technology fit to a problem that we've been trying to solve for an awfully long time, which is what is that payment method that solves all four of those characteristics globally, and frankly is sort of happening without our participation. So Stripe isn't the reason that the world is adopting stablecoins. That's happening for all kinds of other reasons. A lot of them you folks are touching on in terms of the evolution of the stablecoin itself. We're much more interested in sort of the delivery of that utility to merchants who are trying to serve that larger consumer group. So if you kind of pick all of that up and carry it forward one step and say, okay, great, how does that map onto things like recent acquisition of Bridge and otherwise, that's really our ability to kind of lean in on that space and say, okay, great, how do we really get closer to the metal? So how are we orchestrating? How are we solving these problems, directly within Stripe versus maybe quite so many arm's length partner relationships? It's a really exciting moment for us from that standpoint. And I think that's kind of our version of that history is a little bit kind of problem focused with the evolution of stablecoins showing up versus maybe, I don't think Stripe was particularly deeply involved when stablecoins, for example, were the primary settlement currency as opposed to Bitcoin on centralized exchanges.
Yeah. Yeah, so let's talk about adoption then now. From each of your vantage points, what are you seeing as the type of use cases that are the kind of primary drivers of adoption. Because for me, I'm VC, I'm kind of seeing a lot of things across the board. I'm seeing, institutional adoption. I'm seeing, FX, remittances, payments, still seeing trade settlement, like DeFi trade settlement. But I'd love to hear from you, some of the use cases that you're spending the most time around.
Yeah, from my perspective, and also because of the nature of DeFi and Aave itself, yield is a big part of the adoption. So I think that's we have roughly from 30 to 35 billion worth of value in the Aave protocol, which is accessible by anyone. And I think Aave is probably the only place at the moment where you can go and with one single transaction, you can basically borrow 1 billion worth of stablecoins at once, just if you post enough collateral, basically. And it's really significant scale. It's still very small compared to if you think about overall like lending space and finance and so forth. But I think yield is definitely one big category. Then obviously merchant settlements is a very big thing, and being able to settle with stablecoins is providing a lot of speed and also settlements over the weekend. And what I like a lot about the tokenization and RWAs is that we see a lot of RWAs that attach the stablecoin element into the subscriptions and redeemability, and that really adds a lot of programmability into these products. And I think there we're going to see more adoption as well.
Yeah, I would say what's really inflecting right now that I'm seeing is cross-border payments. A lot of fintechs are using stablecoins under the hood, behind the scenes, to move money much faster. Ultimately, I think we get to a world in 5 to 10 years where like the Pepsis of the world are using stablecoins because it's just so much better than pre-funding accounts globally, whether it's in Mexico, Brazil, the U.S., or Southeast Asia. And so that's what I think is really inflecting right now and is like a net new stablecoin category. I think FX is probably the next one, which is probably needs another couple of years to really start to get going. And by that I mean non-USD stablecoins. Those will have a lot less float on chain, but they'll be used at a much higher velocity. That's what I'm seeing now. And of course, you just have continued centralized exchange, DeFi, EM, DeFi mullet kind of growth.
I think for our part, again, I'll kind of always bring it back to payments. It's sort of native to Stripe. We see a lot of rapid growth there. We have a stablecoin payments product that's built in for any merchant to be able to accept stablecoins automatically if they're already on Stripe. We're seeing like really rapid growth on that, both from just international access for digital goods, not necessarily crypto goods either. We see like video game skins being traded around, sort of these like kind of, what we call those like traditional digital assets, like before crypto assets came onto the scene. We're also seeing a really rapid growth in B2B invoice payments, especially international invoice payments, where in AI specifically is one of the fastest growing categories. I think a company, Shadeform, recently put out a tweet about a number of their customers starting to use like large-scale invoicing, preferring to pay with cryptocurrency, mostly stablecoins, primarily just because they would otherwise pay with credit cards. And these are startups that are just accustomed to it. And you could, you can kind of argue this like long list of payment methods that you could use if you're particularly advanced users. But startups are, they're just pulling out the card if they have it, and if they've got a pile of stablecoins, they're more happy to use that. So we're seeing a really rapid growth in that space, which is super exciting. I think if you look down the road a little bit, especially on the AI front, you start to think about like streaming payments and micropayments and all of those. But right now, we're really seeing a rapid growth in just B2B invoice payments, which is exciting. I think we also care a lot about the payouts space, global payouts specifically. Companies like Remote.com, Global Workforces, sort of merges pretty closely with dollar access. Bridge, for example, powers Dollar app, which is one of the like more popular kind of direct dollar access programs, but also just the payouts program in general for global workforces where people just want to receive those dollar-backed assets and hold them. We're seeing pretty rapid growth in that space, mostly at the enterprise level, like larger and larger organizations that already have a global footprint that are looking for additional access. And then treasury finance too. That's growing really quickly. And what's kind of exciting about that one is it's both sides. We're seeing it out in the world, and then Stripe itself is a multinational with pretty complex internal treasury requirements. And we see a lot of our own needs at the treasury level just reflected in our merchants. And Bridge has been a really big tailwind to that in terms of being able to offer more sort of direct and bespoke treasury management type solutions.
And do you think that we're going to have different stablecoins that meet these different use cases, or will one stablecoin be able to converge on all these use cases? I know we already have a bit of a segmentation with yield-bearing stables, right? Which maybe you'll be able to speak more to versus non-yield-bearing ones. But I'm curious, like across maybe the 5 to 6 things we talked about, does it make sense to have different issuers?
I think it's a double-edged sword in that it would be great to have additional competition in the stablecoin space for what is the particular upside you're getting from using it in a particular application. On the flip side of that, it adds additional complexity to the consumer experience or the payer experience or even the enterprise experience on selection. So it's a bit of a double-edged. I'm not actually sure I would predict it yet. I think today Stripe is primarily utilizing USDC. I would not be surprised if tomorrow that was a larger number of stablecoins being supported because of just demand from the industry. But actually interested in your guys'.
Yeah, I sort of segmented it in a few different ways. They're sort of centralized versus decentralized. I think centralized stables will end up having 95% plus of the market.
How do you define each one, just for this crowd?
Right. So centralized, we are the issuer. It is very clearly Agora. We are the counterparty you're dealing with. That's kind of it. Decentralized, a DAO or a decentralized group of decision makers are the counterparty. I think most people, whether it's it's like a shipping business or traditional financial service institution, wants to know the counterparty that they're dealing with and also limit their risk. And when they just want to hold the fiat asset, they want to hold the fiat asset. They don't want to deal with the additional risk of a decentralized organization. So I think centralized stables will continue to win. And then you sort of touched on this yield-bearing versus non-yield-bearing notion. One of the methods that we went about doing things is paying businesses directly, right? Because the issues with having a yield-bearing asset is it's very clearly a security, right? In crypto, a lot of people want to dance around and say, oh, maybe it's a security, maybe it's not. Okay, if you're yield bearing, you're clearly a security, and so that prevents you from being on centralized exchanges, used in payments, and used in pretty much 60-70% of global capital markets. And so what we do is work directly with the businesses and then say, hey, maybe if you want to make it yield bearing, sure, you can do that, right? I think what you'll actually have start to form is these monetary networks. Traditionally, a lot of these older issuers, when they've spun up a new stablecoin, have created an entirely separate entity that is siloed, right? So I'll use Paxos as an example, BUSD, PyUSD, the 2 other stables that they launched are all completely separate structures and entities, so they don't benefit from one another's utility or liquidity profile. What we've decided to do differently at Agora, say, okay, you have one asset, AUSD, that is across many different global exchanges, many different types of businesses use it, and you can build your own white labeled stable on top if you don't want to just use AUSD, the asset, and now you benefit from that global network of infrastructure, utility, liquidity providers, right? And I think that's going to become much more appealing. And then what those folks who are building on top of it can say is okay, maybe I'll add an additional element of risk, right? Maybe Ethena builds on top of AUSD, and then they say, okay, instead of using USTB or whatever, we're going to add 50% is going to be a carry trade or something. And then that can augment, a stablecoin network. And I think you'll start to see more of that.
I would say I need to a little bit disagree with Nick on the decentralized stablecoin aspect, but there's a lot of thoughts there in the sense that from the decentralized stablecoin perspective, I think there is a lot to be said about resiliency. And when you look at, for example, things like, for example, Maker and USDS or Aave's own native stablecoin Go, they provide a lot of resiliency. And from Aave, we started from a starting point where we went directly and built on decentralized systems. So we went and built on chain basically what is a lending and borrowing protocol. And then when we look at the landscape of the whole business field, most of these that type of facility was based on centralized businesses. So we had basically Genesis Lending, Celsius, Salt Lending, and a lot of these centralized businesses that aren't anymore around because they didn't manage their risk properly. Whereas Aave was able to, across all these market cycles, actually retain an extreme resiliency. So I would say that is when it comes to stablecoin, and to Nick's point, it's much more faster to actually grow because you can have a centralized issuer backing these stablecoins, But then when it comes to actually resiliency and more kind of like openness and transparency and that type of element, I think that's where decentralized stablecoins are going to be important. And they might even work hand in hand in the sense that you have a decentralized stablecoin like, for example, Go or USDS, but at the same time, they might use another stablecoin, part of the backing, for example, for different reasons. And eventually, I think DeFi itself will really have a significant impact because DeFi provides like a very perfect environment for creating a very efficient financial algorithms. So it's a game of algorithms in the sense that today Aave might be the best place that you can actually consume yield. But as long as someone comes in and builds something really more advanced, that liquidity flows into that direction. And with tokenization, a lot of these assets are coming on chain and the value comes on chain and there is more liquidity. So I would not discount the decentralization perspective. I would say that centralized stablecoins have a faster path to grow, but there is a need for the decentralization. And the economies of scale will for sure apply that there's going to be probably like few important ones that people want to really think about. Like you don't really want to think too many stablecoins. But I could also imagine that someone who has a lot of customer deposits, they might want to launch their own stablecoin or partner with another stablecoin provider and share that yield opportunity. I've noticed that more recently, I've seen applications where they accept different kind of stablecoins as a way of payment rails to get the liquidity in, and then they convert it to their own basically fiat balances to earn the underlying yield, or alternatively to some other stablecoin. Maybe they have an agreement in place. So it's really hard to say now, but I do think these two worlds will coexist.
Mm-hmm.
This is actually a really good point. We're seeing this categorization as well, where the infrastructure coin, or sort of the internal coin being used, especially for like treasury finance, is emerging really quickly. In terms of, well, we're seeing kind of this small number.
Define that? Like, what does it mean by being sort of the infrastructure, or like the
infrastructure coin is like a privately minted coin, right? Specifically for the organization. I think traditionally it would be particularly centralized, and that's a little bit by design for the organization to use, and they might do it to capture additional yield. They might do it because they're utilizing the coin in a specific way, and they want to manage the reserves the way that they most see fit that's appropriate. Like a couple of other like programmatic reasons, where you might actually set up like the coin to have different sets of primitives. But I think it's just emerging, like starting to see a little bit more where, at the merchant point today, for example, if you use Stripe for payments, we landed into fiat because internally that's what the vast majority, if not, overwhelming majority of Stripe merchants are expecting. You've got a consumer somewhere else in the world, pays with stablecoin, lands to fiat. Where we're sort of starting to see that pressure arrive, right, is, well, maybe it shouldn't land to fiat, but it also maybe shouldn't land to whatever the currency was that was paid into. Perhaps it's a specific coin desired by that merchant. And so anyway, just like reacting to kind of your comment about sort of the internal coin side reminded me, I think it's a really interesting trend because we might actually see a world in the future where there are, countless internal coins and only a countable number of external or open loop coins.
Yeah, and that's probably comes where the abstraction comes into play, where you might have a lot of these internal stable points, but then you have some sort of like, let's say like a USDC or like AUSDC, like as a kind of like a more payment network. So you might want to exchange the infrastructure stablecoin into a more liquid one and then pass it to the, another whoever you're trying to pay, and they might convert it to their own stablecoin then.
Mm-hmm. And what kind of products and use cases are you seeing with financial institutions adopting stablecoins as a part of their business or their infrastructure?
So outside of payments, I would say the main thing is just using it to mint and redeem tokenized assets, right? So whether it's like BlackRock's Biddle Fund or a Superstate Fund, it's just people that are minting it or redeeming it with stable, so that you could do that 24/7. Other than payments and a lot of the things we've already touched on, there's not much that's net new yet.
And how would you say that institutions, when they are evaluating either issuers or protocols to work with, like what are their frameworks? Like, how are they thinking about risk and the benefits of different protocols?
Yeah, I think it depends on where they're based, but since we're sitting in New York, let's maybe talk about US institutions. I think they obviously want a regulated, centralized issuer. They want to know who their counterparty is. They're going to do a credit assessment on the underlying custodian, the fund structure, and do like a real risk analysis. I kind of joke, like, there's basically no risk analysis in DeFi. People just kind of like look for the highest yields and then jump into that. But like in institutional finance, people are going to do like a real credit and counterparty analysis. So I think today, most people in the United States, unless it's like a prop trading firm, they won't touch USDT. Because of that, I don't agree or disagree with that decision, but I think that's just how it is. Or other NYDFS or global capital market regulated stablecoins, some of that. I mean, like Bermuda, Singapore, EU, like the major global capital market hubs. So primarily USDC today.
Generally agreed. Reserve structure, compliance capabilities, general risk posture, and frankly, in the U.S., sort of the direct enterprise relationship in some cases with the issuer, which is available.
And do you think that compliance and regulatory frameworks are going to enable more adoption of stablecoins by institutions? Are there certain pieces of legislation or clarity that you're even looking for? Or do you think that this will inhibit it?
I think it'll grow it dramatically, right? Like I think if the Genius Bill passes and it's very, there's very clear rules on, what stablecoins you're allowed to use and what issuers need to do in the United States, you're going to see adoption probably come forward in 3 years.
I would also say that the devil is in the details. There's competing stablecoin regulations at the moment, but also like if you look at some of the stablecoin regulation just in Europe with MiCA, for example, like MiCA stablecoin regulation piece was basically created Libra in mind, for example, and electronic money tokens. So it just showcases kind of also like a little bit of the disconnection of regulators. In the sense that you already have like some amount of these more like a USDC type of stable coins and that type of market capitalization. So you see kind of like it doesn't really fit the same way. And some of these regulatory requirements, they make it a little bit more difficult to, for example, operate with the stable coins and kind of drives it back to the element of holding assets, for example, in a bank account. And one complete piece that is also like, carved out is decentralized stablecoins. So, so the regulation is a really good thing because it showcases that this sector really matters, and there needs to be some sort of rules and guidelines, because obviously, if you lose trust in stablecoins, you kind of lose trust for the whole system. If you lose trust from one single stablecoin, and something big happens, but it is really unclear for more of the decentralized stablecoins and what's basically regulation there.
And would you welcome regulation even for decentralized stablecoins?
Yeah, again, devil is in the details, because it really depends on the objective. I think the whole point of on-chain is the idea that anyone could actually create innovation any part of the world and advance finance, the whole financial space, and this whole transition from like what we went from like clayboards to paper to digital and now to on-chain, and move our space forward, reduce basically inefficiency, increase transparency, and DeFi has a lot of these elements, and crypto in general. So I think if it goes along those values, it's definitely a good thing. And I think regulation also helps then from the institutional perspective to actually engage with decentralized finance or stable coins in larger scale as well. So definitely it's good.
Yeah, I think that's a good caveat, right? It's like you can have very destructive legislation if it's bad legislation. I think there's some actors in the space that have been trying to win via regulatory capture, which is absolutely bad. But it seems like they're not going to win out, so that's a good thing, at least in the United States, but TBD.
And do you see stablecoins as being a replacement for existing traditional finance and fintech infrastructure, or do you see it as complementary?
depends on where you are. I think in EM there are a lot of places where you don't have financial services infrastructure. It's like totally net new and a great positive for society in those regions. Or you look at Mexico, it's like 50% unbanked, right? With a wallet and internet connection, you can now sort of be your own bank, right? And have access to financial services that are trusted in the form of Aave. So I think it depends on where you are. But in EM, it's definitely net new and it's great.
Yeah, so I mean, generally same answer. There's going to be varying degrees of replacement versus coexistence. I think we're actually going to be in the hybrid world for a good bit longer than most people think. I think it's easy sort of from a crypto macro optimist standpoint to say, okay, great, it's going to be all stablecoins all the time, in 18 months. The reality is we're earlier than we think. It's a recurring theme inside of crypto. We're going to be here for a while. I think to map back to your earlier question about regulation, like it's why we need some kind of a framework there, some degree of clarity to start having that iterative discussion about what's the best way to go and let it come in and live alongside and then eventually potentially overtake traditional finance. I think the treasury finance kind of need, as that grows, will continue to push replacement in pretty exciting ways. And I think we're going to see more participation probably from major financial institutions, the banks specifically, which will maybe sort of walk that line between the two for a while. I don't actually think it's bad to be in the hybrid world for a little while. In a lot of ways, the credit card powered world is a hybrid world. We're operating on sort of a virtualized way of making a payment that settles down eventually into fiat. And that worked very well for consumers and for payments for a pretty long time. Introduced all kinds of new paradigms and new sort of just basic capabilities for the consumer merchant relationship. And I think for a while, stablecoins will do very similar things in ways that we haven't even started to scratch the surface on before they have to go and replace everything. So I think that's exciting, actually, by the way. I think it's dangerous to go and set the goal as complete domination when the reality is we're going to get a ton of value, especially the people in this room, right, over the reasonably short, medium term out of the coexistence of the two.
And I like what Nick said about the location because stablecoins had some very, very interesting adoption in places like Argentina, where you have history of very serious inflation, and you have you still have a lot of chronic problems across the world just accessing a stable value. So that's where it matters a lot, and accessing also dollar yield. But when you look at obviously the Western world and obviously US, but specifically Europe is very bank heavy. They rely on banking system, and it works, and it's not perfect system obviously, but this means that stablecoins just need to have a much higher value proposition here in the Western world, and that's why I go always back to that yield component and decentralized finance, because that provides that I would say a back end for finance in general. So if this idea of tokenization keeps taking off and we move all the value on chain, DeFi will be the actual place where all these algorithms are created to actually match the liquidity and match the needs and supplies and demands and so forth. And it's going to be very hard to compete with those types of algorithms doing it as a traditional lending business, for example. So at that point, it makes more sense to just plug into the DeFi, because you get right away access to liquidity, you get the full transparency, and you can also ensure that things aren't changing because they're either immutable or under very strict governance, for example. So that will actually play quite a big role. So I think fintechs will be kind of like the distributors of these stablecoins, and a lot of the value comes out of DeFi.
And final question, just to wrap things up. What is something that you're either working on or excited about that's going to accelerate the kind of distribution of stablecoins for bridging this gap between traditional finance and decentralized finance?
I mean, I can start. Clearly very excited about Bridge and the recent acquisition and sort of the chain interoperability and coin interoperability, and really providing that connectivity between the on and off ramps of traditional finance and regular finance. I think I'm really excited about seeing where that goes, especially from an off-ramp standpoint. So we think about it very much today as sort of in and out of the dollar, as necessary, but over time we're really thinking about in and out on global rails, in every location that we eventually have to get out to. So more innovation in that space, more application of those technologies, I think really pushes this world forward if we do imagine, kind of to my previous point, that we're going to be in hybrid for a while, like let's go make those pieces so efficient that we can still get the advantage of kind of the pure stablecoin space and crypto space while we're on chain without losing it all on the on and off ramp.
Yeah, something that we're working on the institutional side is you sort of see tokenized treasuries take off over the last 2 years. They're now several billion in AUM. But one of the challenges with them still, and why they kind of have a low degree of utility, is you can't on and off ramp them 24/7 without having a credit facility in place, which is expensive. And so something that we've done is onboarded the major high quality RWA issuers, so like BlackRock. They're next going to have a product shortly, Superstate, et cetera. And if we've whitelisted them, you're now going to be able to move out of those assets 24/7 and unlimited size, which should hopefully unlock their utility in DeFi. So in particular, and I'd love to work with Horizon or Aave on this, is Morpho is going to have these levered T-bill vaults. We can now be that liquidity engine that's powering it, right? Because they can hook into our system. But also with centralized exchanges as well that want to take tokenized treasuries as collateral, they can, these market makers or OTC desks are now more comfortable doing so because they can actually get out of that into a stable coin with global liquidity 24/7. So that's something that we're working on the institutional finance side. That's a little bit of an alpha preview.
Yeah, it's very super exciting. And on Aave's perspective, we're basically working quite a lot on actually growing Go and specifically the ways to mint Go in a, Aave is essentially a DAO, so it's a decentralized system and smart contracts. And the Aave native stablecoin Go, the way it's minted is that the DAO gives a bucket essentially, which is a facilitator, and under that facilitator you have a specific use case. So it's a typical use case to mint Go is actually to borrow against the collateral on Aave. And the big difference between borrowing the Aave native Go compared to, let's say, other stablecoins is that 100% of that borrowing interest rate is going to the Aave DAO. This means that just 100 million worth of Go is actually earning to the Aave DAO the same amount of that 1 billion worth of USDC. And currently there's 200 million worth of Go outstanding, which basically means it's yielding at 2 billion if it will be compared to USDC. And then the more interesting piece comes here is that now that the decentralized organization is getting this yield, how to redistribute that yield back to the users by creating a savings product. And that's the component we're quite excited about and scaling and creating more of a savings Go type of product. Then we also work on other types of facilitators where you can actually mint Go against a RWA like Biddle. That's an interesting project. And yeah, those are probably the main thing in my mind at the moment.
Yeah, amazing. Well, thank you to our panelists. And if you have any questions, I think we'll hang around for a bit afterwards. And looking forward to the rest of the program.